There are three things that the Federal Reserve Bank is worried about in 2023. Number one is inflation not falling fast enough. Number two is asset prices falling. And number three is the economy slowing. In their December meeting, the Federal Reserve Bank, which is our central bank here in the United States, said that they expect inflation to be higher than expected in 2023. The reason why this is so important is because while we've been seeing high inflation for the last couple of years, we haven't really seen the full effect of high inflation. What are you talking about, Jaspreet? I'm struggling to pay for my groceries. I'm struggling to pay for a vacation. I'm struggling to pay for my rent. What do you mean we haven't seen the full effect of inflation? And you're right. For all intents and purposes, the average American is already facing a recession in their own bank account. However, we haven't really seen the full effect of inflation because people have had a lot of money. People have been able to pay over MSRP for a car, which is what pushed car prices higher. People were able to outbid each other for homes, which is what pushed home prices higher. People were able to outbid each other for pretty much everything, which pushed the price of so many things higher because people had money to spend. Let me read you a couple sentences from the JP Morgan Chase Bank Economic Outlook Report for 2023. What this said is that household balance sheets are still looking healthy by historical standards, although a meaningful portion of the excess savings and liquidity built up during the 2020 and 2021 pandemic has been depleted over the course of 2022. What that means, according to JP Morgan Chase Bank, is that the average household in America looks healthy financially by historical standards, but the reason why they look healthy is because people in America still have excess cash saved up from 2020 and 2021 thanks to the help of stimulus checks, thanks to the help of unemployment checks, and thanks to the help of whatever other financial aid was given out during the pandemic. They go on to say that Americans had somewhere between $2 to $2.4 trillion of excess savings from the pandemic, which is now at somewhere between $1.2 to $1.8 trillion, and depending on the path of inflation and the pace of consumer spending over the next several quarters, this excess savings could be fully depleted by the middle to end of 2023. Let me help diagram what this means. So on one hand, we've been facing this high inflation. However, we haven't really felt the full pain of this inflation because people have had the ability to spend. Why have they had the ability to spend and pay higher prices? Well, thanks to the pandemic, all the excess and free money that was printed and sent out is still out there. Now, what JP Morgan Chase Bank is predicting is that by the end of 2023 or middle to end of 2023, we're going to run out of this excess cash. But we still have this high inflation. I mean, the inflation hasn't gone away. Maybe it has cooled down, which means the price of things are still growing very quickly, but they're not growing as fast as they were before. Unless we see negative inflation, which would be deflation, we're not seeing the price of things fall. So we're still seeing the price of things grow very quickly, while people's savings are dropping very quickly. And then once people's savings die, they go away, now people have to pay for the high prices of things, which will be higher in 9 months than they are now. Even though it might not grow as fast as it was growing a couple of years ago, it's still growing very quickly, but then people will have less ability to spend. So you have people's ability to buy things falling very quickly, while the prices of things are rising, not as fast as they were, but still rising very fast. This is the first inflationary problem that the Federal Reserve Bank is worried about, that they're trying to bring inflation down. How are they doing that? By trying to reduce the demand by increasing the price and cost of things. They're working to increase interest rates to bring inflation down because it's high inflation. As soon as people run out of this money, is really going to start hurting more people because now you have people that have no savings, that don't have the ability to spend, while the prices of things are still extremely high. The second thing that the Federal Reserve Bank is worried about is the stock market and the real estate market falling. Not because they're worried about the prices of stocks and real estate, but because of what that might signify going forward. Now, if you do want to stay up to date on what's happening, when it's happening, then you should join something like Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in the housing market, the stock market, the crypto market, inflation, and the global economy. It's a super fun and easy to read email. You can read it in less than 5 minutes every morning and is completely free. So if you haven't joined Market Briefs yet and you want to stay up to date on what's happening in the markets, I'll put the link to how you can join Market Briefs down in the description below. The Federal Reserve Bank has been working to raise interest rates to bring inflation down, and the effect of higher interest rates is, not surprisingly, that it's more expensive to borrow money. And when it's more expensive to borrow money, that hurts businesses, meaning the stock market, and that also hurts the housing market and the real estate market because, well, it's more expensive to borrow money. But the real concern isn't really just that stock prices or real estate prices might fall because of higher interest rates. It's what might happen because stock prices and real estate prices are falling, especially when you consider the fact that we have the highest amount of debt ever right now. Let me show you what I mean. Let's assume that you bought this home for $200,000 and you decided to put down 10%, which is actually higher than what the average down payment has been over the last couple of years, because over the last 18 months or so, the average down payment has only been about 6%. So if you put down 2%, that means you put down $20,000 and you financed $180,000 of debt. Now, if a year from now, the home value goes up to $300,000, what does that mean? Well, for the average American, what that means is now you can go to the bank, you can refinance some cash out, pull out another $50,000, $60,000, $70,000, put it in your pocket, and now you can go out and buy a boat, buy a vacation, buy something else. It's good for the economy, not good for you, not something that I would recommend. But what happens now if home prices fell? Not to, let's say, $180,000, but what if they fall to $160,000, where now you were underwater on your home? Well, it's really not that big of a deal. Sure, now you can't go out and refinance and go out and buy a boat, but if you have the ability to continue making your payments, now that's really not a big deal. Yeah, you're underwater. The economy might not boost because you can't go out and buy the boat and all the nice stuff, but everything is fine because you still have your job. You can still make your payments, so it's not a big deal. But if you lose your income, if the economy slows, I'm going to talk about the economy in just a little bit, but if the economy slows and you lose the ability to continue making your debt payments and now you're underwater, that's when the debt becomes a problem. Too much debt is not a problem until it becomes a problem, and too much debt can become a problem when you lose the ability to make the payments on your debt. Because now if you're underwater, you can't refinance because no bank is going to want to refinance you when you owe more than what the home is worth. And you're not going to be able to sell because if you wanted to sell this $160,000 home, well, you're going to have to bring $20,000 to the closing table. Maybe you pay down 10 grand, but you still got to pay a lot of money at the closing table in order to sell this home. So now you're stuck. Now instead of mailing in your mortgage payment, you're going to have to mail in your keys. This is what the worry is, because if this starts to happen and now people are underwater and they lose their income, that could cause an even bigger problem in asset prices. That's what could turn a correction into a bigger crash because people lose the ability to pay, and now you start to have involuntary sales of assets, whether it's stocks, whether it's real estate, because now people are being forced to sell not because they want to, but because their lender is saying that you have to sell because you lose the ability to pay. In the stock market over the last couple of years, we have seen this big boom of margin trading, which is people trading and investing their money on debt given to you by a stock brokerage. Now, I don't recommend you do this, but over the last couple of years, because interest rates have been so low, we have seen this huge boom in margin trading. This is directly from the FINRA website, and what you see is that towards the end of 2022, we had about $643 billion in outstanding margin debt in the stock market. While this is lower than our peak during the pandemic, it is at pretty much the highest levels that we've ever seen even before the pandemic. We have more outstanding margin stock market debt today than pretty much any time before the pandemic, except maybe a few months in 2018. But besides those few months, we have more margin debt today than ever before, while the interest rates are rising very quickly, while we've been seeing stock prices in general fall. And in the housing market, we have way more housing debt than ever before, and this comes at a time where housing prices have just begun to fall. Now again, home prices falling and stock prices falling don't mean anything unless the economy also slows down, because if the economy also slows down, that means that people lose jobs. And if people lose their jobs, that means they lose the ability to continue making their debt payments. If you lose the ability to make your debt payments, that's when the debt becomes a problem, and we're at a time where our debt levels are at the highest we've ever seen. Now, when it comes to the economy slowing, this one's going to be the most tricky to understand because you don't really see it most of the time until after the fact. But now what we're seeing happen is we've been seeing a lot more layoffs in the tech sector, we've been seeing more layoffs in the banking sector, and now we're starting to see people spend less and less on discretionary things. Like we're seeing less and less people spend money on Airbnbs because people just don't have the ability to spend. We're seeing less and less people buy cars because it's getting more expensive. We're seeing less and less people go out and buy homes because it's becoming less affordable. This is now where you can start to see everything tie into one another, because on one hand, we still have inflation being very high, meaning that the prices of things are rising faster than people's incomes, meaning every single day less and less people have the ability to continue spending. And if people have less ability to spend, that hurts the economy. If the economy is hurting, that means businesses are making less money. If businesses are making less money, well, that means they're going to have to cut people. They're going to have to lay people off because they're going to have to lower their expenses. Not to mention the fact that higher interest rates also hurt the economy because that makes doing business more expensive. So the economy is also hurting partially due to the high inflation and partially due to the fight on inflation, which is the higher interest rates. Now, if the economy is hurting and people lose the ability to pay, people lose the ability to spend, people lose their incomes, that also hurts asset prices. For one, that hurts because now people have less ability to buy stocks or real estate because you have less money coming in because the economy is hurting. But also because now people have these expenses, they have these debts on these assets, and now they have a tougher time paying their assets because, well, now they don't have the income from this economy. They're not making the money that they were before, so if you're levered up on your assets and you struggle to make your debt payments, that further hurts asset prices. So you can start to see now how everything is tied into one another, and this is where now the Federal Reserve Bank is trying to play this teeter-totter game, trying to watch what happens. They want to continue raising interest rates to bring this down. However, that's not going to happen without hurting this. Not to mention the fact that the economy is hurting also because of this. So the economy is hurting because of this, it's hurting because of the fight on inflation, and now the hurting economy will also hurt asset prices. This is where you want to be a smart investor. Be patient, because everybody here is like, what's going on? When is it going to happen? When's the crash? Where's the crash? Listen, you got to understand how things tie into one another, and if you want to find the good opportunities, this is where you just got to be patient, understand what's happening, and continue to look for the right opportunities and be prepared and be able to go out and actually capitalize on these opportunities. That means you need to be prepared with cash, and you have to be financially educated to know where the opportunities are, because ultimately then asset prices are the ones that get hurt, and this is where it creates opportunity for you as the investor. Because I don't want you to be one of the people that just gets hurt and screwed over by the system. I want you to be one of the people that understands how the system works. That way you can use it to your advantage. Going forward, when they raise interest rates, they're not going to look at the inflation levels and the job levels in a snapshot. Instead, they're going to essentially look at a live photo, and they want to look at what direction inflation is heading, and they want to look at what direction the job market is heading, and based off of the trends that they see as opposed to what's happening right now, they're going to